Mike Brown, the MD of ETFSA, joins us now for a look at exchange-traded funds and exchange-traded notes as investment vehicles. Thank you so much for making the time to join us.
Pleasure.
Let's first get the difference between the two. What's the difference between ETFs and ETNs?
Well, ETF's an exchange-traded fund, and that physically holds a portfolio of shares that exactly replicates an index, and so it's 100% safe in terms that it's underlined 100% by the assets it tracks. Exchange-traded note is something that gives you the same sort of performance, but it's impossible often to physically hold the underlying assets. You've got an exchange-traded note in something like wheat or corn. If you physically hold the wheat or corn, it goes off after a while. So JSE allows you to run your liability by just issuing a note, a promissory note that will give you the performance of that particular asset class. But both of them are traded on the stock market, and they give you a low-cost entry point into being able to save in specific asset classes, bonds, equities, whatever have you.
Mike, it's been an asset class phenomenon over the last sort of 10 to 15 years and more recently in South Africa. But if you take 100 Rand that's invested on the regulated exchanges of South Africa, notably the stock exchange, as you put it, how much of the 100 Rand is invested in ETFs or ETNs? Is it growing?
It is growing. The ETFs this last quarter went through 100 billion Rand in total, in terms of total assets under management. And 5 years ago, that was something like 15 billion Rand. So it's growing almost, I won't say exponentially, but faster than any other savings product in South Africa. So they're products for the man in the street, low cost, easy to understand, and they give you from 300 Rand a month or 1,000 Rand lump sum, you can start investing in the stock market or start investing in the bond market.
Mike, you were behind the first ETFs that came to the market. How many years ago is that, and how many have we got now?
Well, it wasn't all that long ago.
Give us a range of what you can invest in.
It was about 2000. Yeah, the interesting thing now is that you've got over 70.
70
ETFs. And so you can invest in different types of equity sectors. You can invest in bonds, you can invest in commodities, you can invest in currencies, you can invest in listed property, all using ETFs. Now, for the less sophisticated person who doesn't know which shares to pick or doesn't know the access to the right sort of asset managers to pick it for them, ETFs are a very, very good asset to start with. Like many good assets, if you know what you're doing, you can make them work for the big investor as well. And so there are benefits for both small and big investors using ETFs as the building blocks. But yeah, it was 10 years ago, now it's 70.
Mike, I've got a question for you regarding I know we shouldn't try and compare ETFs and unit trusts, but there's a great similarity between the two, of course, as far as I'm concerned, especially with some. However, it does seem like the entry level on the ETFs, that it is a slightly lower entry level than is often the case with unit trusts. I mean, 300 as opposed to often 500, and 1,000 as opposed to, I think, as high as 20,000.
Yeah, the entry level is a bit lower, number one. The costs are lower, number two. Secondly, you're getting direct access to whatever asset class you want in an ETF. So if you want an ETF that just gives you mining shares, you can buy an ETF, gives you mining shares. If you go to a unit trust, you're really buying what they call in America TV dinner. You know, TV dinner has a nice picture on the front that says it feeds four, it only feeds one, and what's inside isn't anything like it looks on the picture. And it tastes like the cardboard it's packed in. So, but when you're doing ETFs, you're not relying on an asset manager to pick his choice of an asset class. You can do it yourself. So if you've got, either you do a bit of your own homework or you find an asset manager who understands passive investments, and you can put together portfolios of ETFs very successfully. And that's where the real growth is happening in South Africa at the moment, is just running passive. And ETFs are passive investments that just replicate an index, running passive portfolios.
At the moment, Mike, who's using it? Is it the institutional market? Is it the retail market? Is it a mixture of the two? And if it's a mixture of the two, which one is going to grow in the future, would you say?
Well, that's a sort of question we can say both. I mean, we've got some of the ETFs like the commodity ETFs, which are almost entirely bought by institutions. And there's been something like 40 billion Rand has just gone into commodity, gold, platinum and palladium ETFs. But the man in the street buys things like Statrix 40, the top 40 index, he buys the industrial index, he buys the listed property index. So it's a bit of both. The real growth happens when institutions start getting into ETFs. We've seen it around the world. And in South Africa, we still have an institutional market which tends to believe it can outperform the market. Now, we all know the mathematics indicates that that's not the case. 80% of all your institutional managers in South Africa can't beat the index. And over time, as that gets understood, then more and more people will start turning towards index tracking products. And ETFs are an ideal place to start.
That's a big thank you to Mike Brown, the MD of ETFS.